Hello and welcome. Today is Wednesday, February 14th. Happy Valentine's Day, everybody. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and the founder of Alpha Insights. And this is your Daily Five. Daily Five is the show where we go through the most important five charts that are really just top of mind for us. And before we get started, I wanted to first just give you a quick heads up that we will be publishing the next issue of Huge Insights, The Big Picture, our investment newsletter, on March 2nd. And those of you who have followed my work know that we publish a monthly newsletter every month. It goes out the first Saturday of each month, kind of following the NFP report. The newsletter is affectionately titled Huge Insights, The Big Picture, because we cover the big picture macro factors that are affecting the economy and the markets. And we give you a general assessment of what we think is happening out there and what the drivers are. But we get a lot of inquiries from our viewers and readers saying, hey, Jeff, we love your perspective. How do we put it to work? So, we've created a more detailed version of the newsletter for those who want to upgrade to pay. That is an option for as little as $12.50 a month. And that includes a deeper, more granular look at our monthly forecast and outlook for equity markets and our actual positioning recommendations. In fact, paid subscribers also receive our weekly Alpha Insights Idea Generator Lab publication. This is a institutional grade report that details our top actionable trade idea every week. It goes out at the end of the day on Wednesday and actually provides some additional market commentary and insights from that perspective. We also provide our paid subscribers with some interim bulletins from time to time, and also video content that is not available anywhere else but directly from us. And this is typically private conferences that we attend and speak at, and have our presentations recorded, at which point we are able to send those out to our paid subscribers. So a nice added piece of value here for those who are interested. That being said, let's move on to the first chart we're going to kick off with today. And this chart really looks at year-to-date returns for a variety of key markets. As all will know, the Nasdaq 100 is leading the charge, up over 4% year to date. The S&P 500 is not far behind. Through the close of February 13th, it was up just shy of 4%. But behind those two, big cap, mega cap capitalized indexes, the rest of the market is really kind of biding its time. In fact, T-bills are outperforming every other major sector of the market, with the Dow just basically flat and the average stock actually negative. If we look at the equal weight version of the S&P 500, we can see that the average stock is up negative 0.43% year to date versus T-bills being up positive 0.6%. Mid caps are also negative. Small caps are negative. We can look at international stocks down some 2%. Micro caps down almost 4%. Small caps down 4%. Banks, specifically regional banks, down over 10%. Interestingly, if we look at the value line geometric index, which basically takes the top 1,700 largest stocks in the U.S., it's down almost 3%. It's an equal weight index that includes the Magnificent Seven and all the other mega caps that are affecting these bigger returns here because of their capitalization and weighting within the major indexes. So, year to date, things are pretty mixed, I think. And from a broad market perspective, things do not seem to be going well. Chart number 2 gives us a sense of maybe why is this the case. There's a well-known indicator out there called the Hindenburg Omen. Some of you may have heard of. This is a study that was developed by mathematician Jim Mika following the crash of 1987. He became very interested in developing an early warning system for the for identifying future stock market declines. And after years of exhaustive research and analysis, Mika actually determined that 3 concurrent preconditions must be met before a major stock market reversal was imminent. The first one he discusses in his work is that the NYSE index must be higher today than it was 50 days ago. So, basically he's looking for a positive trend. The second point was that the number of NYSE new 52-week highs and new 52-week lows must both exceed a certain threshold that he defined as 2.8% of issues. What does that really mean? It means that there's a disagreement between the bulls and the bears, that there's a lot of new lows being made at the same time that there are a lot of new highs being made. And so this shows that there's a tug of war going on between bulls and bears. And then the third condition is that the NYSE market breadth, as measured by the McClellan oscillator, must break below zero. Now, the Hindenburg Omen was actually originally developed based only on NYSE data alone. And, it had a pretty good track record right out of the gates. In fact, it was dubbed the Hindenburg Omen based on the 1937 Hindenburg Zeppelin disaster because it was so good at identifying major changes in the market and getting investors that level of awareness before they occurred. But since, I think sometime in the mid to early 2000s, someone decided to run the exact same study using Nasdaq data. And so they developed a Nasdaq version of the Hindenburg Omen based on the exact same criteria. Empirical evidence since that time suggests that the model itself is most effective when we get dual signals generated in both data series simultaneously. So both the NYSE and the Nasdaq both have to signal a Hindenburg Omen at the same time in order for it to have maximum impact. And in fact, all three of these preconditions were in fact met on February 8th for both the NYSE and the Nasdaq Composite indexes. And so as we can see right here, we did get a Hindenburg Omen in the NYSE data and a series of Hindenburg Omens in the Nasdaq data preceding February 8th and occurring concomitant with the NYSE signal on February 8th. The last time that we saw a dual signal from these two series was back on November 22nd, 2021. That was the exact date of the NASDAQ 100's peak prior to the 2022 decline. And so you can see that we got an NYSE signal and a NASDAQ signal on November 22nd. So I guess based on that information alone, we should probably, pay some attention to the notion that, perhaps something is developing here, especially with yesterday's price action in reaction to a hotter than expected CPI number and, the long-standing track record that the Hindenburg Omen has had in preceding major trend changes. So with that said, let's look at chart number 3. Chart number 3 comes courtesy of Charlie Baleo. Charlie's a guy who looks at a lot of different statistical data and publishes studies pretty regularly. I don't follow his work specifically per se, but occasionally some of his work does show up on my Twitter feed. And one such study that he published last week is detailed in this chart right here. And what it really shows is that the S&P 500 energy sector compared to the market cap of NVDA, if we total up the entire market cap of the S&P 500 energy sector, it equates to about $1.574 trillion. The market cap of NVIDIA at the same time of the study, which was based on last Friday's closing prices, was actually 1.782 trillion. So we can see that one company in the tech index now exceeds the value of the entire energy sector by over $200 billion. When I saw this, I immediately had a flashback in my mind to March of 2000. Back then, it was Cisco Systems that was catching everybody's attention. Cisco had just surpassed Microsoft as the most valuable company in the world at the time. It had reached an unprecedented market cap of $546 billion, which was absolutely mind-boggling in March of 2000. the comparison that we heard back then was that, investors had bid up the market cap of Cisco to a point where the value of the company at that time exceeded the value of the entire global automobile industry, which was, a major industrial industry back in 2000. So if we look back to March of 2000, we can see that situation did not end well for Cisco shareholders. But if we didn't know anything that we know past March 2000, investors were absolutely enamored with Cisco. The company was hitting on all 8 cylinders. They had the best product in networking, internet, paradigm shift was all the rage. That's all investors could talk about. It is exactly what we're hearing with respect to AI and how NVDA is the company that makes the picks and shovels for the next AI wave, just as Cisco made the picks and shovels for the internet age. And, I think a lot of this is built around the madness of crowds. I can tell you, as someone who's used ChatGPT, I can tell you that 75% of the queries that I put forth to ChatGPT are either I don't know or some sort of a hallucination. And the only reason I can tell you that it's 75% and not 100% is because the other 25%, I haven't had time to check them for errors, specifically enough. And it's highly probable that something closer to 99% of the queries come back with some kind of an error. So I think that we're way ahead of our skis right now in terms of this AI paradigm shift that so many people are embracing. And while it's certainly something to keep an eye on for the future, I think that we are many years away from, AI producing tangible results for investors, put it that way. And so when I see these sorts of valuation discrepancies, it's just a deja vu circa March 2000. And I think we should be aware of that valuation perspective. Another valuation perspective that I think is noteworthy at this point is the relative price of the tech sector versus the rest of the S&P 500. This particular chart shows the tech sector since about 1990 to present relative to the S&P 500. So it's a ratio of tech versus the S&P. And right now, technology represents about 30% of the market cap of the S&P 500. And the near vertical advance that we've seen since about October of 2022 has now carried prices above the prior March 2000 peak that was in place here to new highs. And obviously, we've made a very recent new high as the S&P 500 itself is carried above 5,000 in recent days. This extreme really kind of raises my eyebrows quite a bit because, it got to these sorts of excesses back during the dot-com bubble peak achieved back in March of 2000. And the subsequent months and years that followed were not pleasant for technology investors. In fact, one of the things that has caught our attention is that according to data from S&P Capital IQ, the tech sector itself currently trades at a forward 12-month PE ratio of 29.4 times. That exceeds the valuation of technology back at the March 2000 peak. Meanwhile, if we were to take a look at the momentum of relative strength, it's actually losing momentum and pretty quickly. So I think it's another warning sign that we are not in the neighborhood in which you would want to commit new capital to technology relative to other stocks out there. Chart number 5. Sentiment just hit another new bullish extreme. We've been talking about a variety of different surveys in recent weeks and on these videos. Yet another well-regarded investor sentiment indicator, the Investors Intelligence Advisors Sentiment Survey, just posted a new 30-month extreme with bullish advisors coming in at 58.8%. But more importantly, net bullish advisors, that's when you look at the bulls divided by the bulls plus the bears, they actually came in at 76.8%. So that level obviously exceeded the July highs that we saw and even the December highs recently. I think that we should be aware that the last time sentiment got this extreme back in July, it preceded an 11% decline over 3 months in the S&P 500 from this point to this point. So something to be aware of. Another thing that I would say is that expectations appear to be very high at present. And I think that the markets are liable to disappoint investors. This Investors Intelligence Advisor survey complements the results that we've been, seeing from a number of other surveys that we've discussed. This would include, say, the NAME Exposure Index of professional asset allocators. This would include the AAII survey of individual investors, and more recently, Consensus Inc.'s survey of major institutional investors, all of which are showing, extremes of the same nature, multi-year extremes over the past several weeks we've seen. And, these recent bullish extremes exhibited by all of these surveys represent a stark contrast when considered in the context of the record insider selling that has been witnessed year to date. So something to keep in mind. One more chart. This is a bonus chart. This is what we've been looking at with respect to the S&P 500. As all will know, we practice a strange religion, as some would call it, using the Elliott wave principle to identify where we are in the trend of the market. And as you can see, from about October 13th of 2022, we've been in this choppy advance, and it seems like it's a bull market advance to most out there. In fact, we moved up from around 3,500 to 5,000. And that's a pretty big move in market terms. And we've counted this out most recently as a 1, 2, 3, 4, 5 wave impulse pattern at intermediate degree of trend. What we've been really focused on since the October 27th low of last year is this particular move up. We've been dead wrong on this all the way up. I got to be honest with you all. We thought for sure right around here is where it would top if we get the next leg down, but that did not happen. Instead, we got a gap and go here, and the market rallied to a new high, then pulled back and consolidated here in the early part of the year. And now we've gotten another push up. But when we drill a little bit deeper down into this pattern, we can see that this is counted up as a 1, 2, 3, 4, 5 wave extended pattern at minor degree of trend. And when we actually look at that fifth wave on a minor degree scale at minute degree, we can count 1, 2, 3, 4, 5 waves up. That 5 wave pattern pushed up to the upper boundary of a parallel trend channel that connected the primary wave 4 low with the intermediate wave 4 low, the 2 October lows, 22 and 23. And then we've just taken that and attached it to the July high. And we just barely ticked over the top of that July, or I should say the top of the upper boundary of that parallel trend channel, and have reversed back down with yesterday's gap down. Now, today we've moved up a little bit. This chart was printed off at yesterday's close, but it looks to us that we're setting up here for a fill the gap and break. And our expectation is that this was the end of that 5 wave advance at intermediate degree, which satisfied a 5 wave advance at primary degree, which also terminated a 5 wave advance at cycle degree and a 5 wave advance, or I should say a wave 3 advance at supercycle degree. If we're correct about this, that the market is topping here at 6 degrees of trend, then we think the next leg down should be very severe. We've marked all the open chart gaps on the downside here, that still remain open. And, we think the next stop's probably 48.02, then 44.11. Then we should start just knocking these out one by one all the way down until we take out the October 22 lows and make new bear market lows. We think that's going to happen over the course of the next several months and years for that matter. Indeed, if this is a super cycle degree top, as we suspect it is, we could be in for a decade of bear market sort of results in the S&P 500. And that would not surprise me given the valuations from which we're starting at here and the expectations of investors. So having said that, I'll leave off by just suggesting also that the breadth of the market has been exceedingly weak over the course of the last month and a half or so. And yesterday we got down to around 50% of S&P 500 companies trading above their 50-day average, moving average. That's not typical of bull markets when we see that sort of a breakdown here from a recent high. This negative divergence is definitely signaling a larger degree move to the downside. We haven't illustrated it in this chart, but we also have negative divergences evident at daily, weekly, and monthly timescales in momentum, looking at a whole variety of different momentum studies. All are diverging negatively, and as experienced traders will know, a negative divergence in momentum and breadth tends to precede a major trend change. It is a bearish condition that we should be aware of and prepared for. So with that said, I just want to thank you all very much for your attention today. If you'd like to follow up with me, you can always go to our website at www.jwhinvestment.com. You can follow us on Twitter at alpha_insights, or you can check out our newsletter on Substack. That's available at hugeinsights.substack.com. Thanks again for watching, and best of luck to all of you trading.